Is it okay to start, Francis?
Yes, it's time.
Okay, I'm going to read, before we get started, I want to read a brief statement. This meeting is taking place over video conference. If the video conference is disconnected anytime during the meeting shall be stopped and reconvene once the video connection is restored. If communication is unable to be restored within 15 minutes, items remaining for consideration will be continued to November 9th, today, at 1 p.m. Central Standard Time, via video conference. And with that, I'd like to call the meeting to order.
Do you have some language, Brent, about what happens if someone wishes to speak to us? Someone who is not on
Yeah, I can add it. To speak on a certain agenda item, to participate, you can call 1-877-8535-5257 or 1-888-475-4499. To speak on a certain agenda item, please call in advance, but that's too late. You can reach out to the city clerk at cityclerk@okc.gov, and staff will be able to help you there. With that, we'll go to item 2, which is approve the minutes of the meeting of August 10th, 2020. Well,
Did you lose your voting screen?
yes, I did.
Okay, go down to Chrome and click open Chrome and it should pop back up.
There we go. My apologies.
Trustee Garrison, how would you like to vote?
Oh, I'd vote to approve.
Passed unanimously, 5-0. Item 3 is elected vice chair trustee to preside at trust meetings, perform chair trustee duties in the absence of the chair trustee. Could I get a motion?
I motion for Laura Johnson.
This is Garrison. I'll second it.
Just beat me to it there, Amy. I was going to nominate you. Do I have to abstain from this vote?
No.
Okay.
You can actually vote for yourself, I guess.
Awesome.
Trustee Garrison, how would you like to vote?
Affirmative.
He was able to second that. Can he not vote on that in PrimeGov?
Oh, I'm on an iPad.
Oh,
And the motion passes 5-0. Item 4 is a presentation investment performance review period ending September 30th, 2020. And then we, at the same time, we'll also receive the monthly investment reports on item 5 for the period ending July 31st, August 31st, September 30th, and October 31st. And we have Doug Anderson here with us today from ANCO. Doug?
Am I muted still?
Not now.
Okay, thank you. Good morning, everyone. How am I? I'm going to see if I can. I am not able to share my screen, so if
We can give you permission.
thank you.
Dina, did you give him permission?
You're the host, Francis.
Oops.
oops.
See, I'm on my iPad where. There we go. Okay, Doug, you should have permissions now.
All right. There we are. Okay, so I'm going to go to, this is a performance report for September 30. It's November 9th. This is about the time. Normally, we have to share this. Thank you for allowing me to present today. And while this is convenient to do it over video, I'd much rather be doing it in the council chambers. Look forward to that early next year. Looking at the market environment is the first place that we like to go. I'm not going to spend too much time here, but a few things. International equity, this is where I'm showing right here. Hang on. Full screen mode. Is that better for everyone?
Yes.
Yes.
So this is the quarter performance. So this is the July 1 to September 30 period. And while we have seen a lot of volatility in the marketplace, if you look here for the third quarter, that's the end of the summer effectively, international equities, which is this bunch right here, the maroon, were positive, up 6% for all countries, up 4.8% for so-called developed countries, and 9.6% for emerging markets. And that's a large part of that is China. If you look at the US equity market, it looks to be very strong results during the quarter. And that's true. If you look at the all-encompassing or the core benchmarks, S&P 500 up almost 9%. And remember, this is after a very strong second quarter of this year when we were coming out of the coronavirus market crash, where the markets were up almost twice as much in the second quarter. But you can see that the returns here for these large cap indexes, the S&P 500, Russell 3, and Russell 1000, are very strong, up 9.5% for these. And these are broadly illustrative of the large cap part of the marketplace. You look down to mid caps and you look to small caps, and the returns are very, very different. Markets are being led, markets are being dominated in a positive fashion by ultra mega cap companies, the biggest ones out there. And those are largely the big five technology companies: Amazon, Apple, Microsoft, Google / Alphabet, and let me see, what am I missing here? Apple,
Amazon.
Apple, Amazon, yes. So extraordinarily large companies out there. And they are driving a great deal of the performance. If you look at small caps, the Russell 2000, they're not keeping up. However, today they're seeing a significant rally, which I don't know if you've seen the markets. Markets are, the news of the vaccine and other things are making markets rally significantly today. And remember, we're fully invested in this portfolio. We don't make decisions to decrease risk or increase risk. And we've got quite a bit of equity exposure in the portfolio. So today will be a very good day for the trust. If you look at fixed income, this is the other component that we have in the portfolio, a major component. You can see returns are pretty modest there for the quarter. And then when we go down to the trailing year, just how different performance is here. So S&P up 15%. So this includes the COVID crash in that 15% rate of return. And you can see that returns have been uneven also. US equity markets, again, mega cap companies are driving, and you can see that through these measures here. But mid cap and small cap companies are not as, they have not benefited from the rally nearly as much. You can see US has outperformed international by a pretty significant margin over the last year also. Again, emerging is better. You can see that developed is poorer. And remember that the COVID crisis really hit China first, and well in advance of other parts of the world. Looking at bonds here, it's a good year to be investing in bonds. 7.0% return for the core bond marketplace. But we don't expect this going forward. There is not a mathematical way that we can expect returns like this going forward. We need to recalibrate our return expectations for bonds. I'm seeing lots of folks writing and thinking about this. How do I, hit a 7% rate of return target, just, pulling one out of the air, if half of my portfolio has an expected return of under 2%? It's very difficult. The yield on bonds in general is very, very low, and we do not expect bond yields to increase anytime. The Federal Reserve is sort of indicating 2023 before they'll start raising interest rates. And remember, if interest rates go higher, it actually hurts your bond portfolio. So about, unless yields go much lower, which it's hard to see that they will, given 30-year treasuries, about 1.7. Could go lower. It has gone lower, but that indicates severe economic stress if it does. Here's something else that I really want to point out here. I mentioned how different returns between large cap, mid cap, and small cap are. It's really dwarfed by the difference between growth and value. So during the quarter, remember the Russell 3000 was up 9.2%. Russell 3000 growth was up almost 13. The Russell 3000 value is up 5. And you look at this pattern where growth is outperforming value, not only this quarter, but over the last year. So if you were invested in large cap growth stocks, you're up 36% over the past year. If you're investing in large cap value stocks, you're down 6%. So really the biggest delta here, the best place to be, large growth. The worst place to be, small value. So it's really on a diagonal here. And this is unusual. 36% gain for large cap growth stocks, but a 15% loss for value stocks, small value. That is one of the most unusual observations I have ever seen. And what it means is that markets are favoring the biggest, safest companies out there. And until we have a vaccine or things normalize even more than they are, it's going to be tough to get people to move out of this position, out of this idea that we're investing in the biggest, most stable companies, and go down to more risky companies down here. The nice thing about these smaller risky companies is that they're very cheap compared to these. These are very expensive right now, but small cap and mid cap value stocks are much less expensive. Here is how we got here. Remember, technology is a huge name. So technology itself, if you take it one slice deeper, up 48% over the quarter. That's amazing. Apple went from, it hit the $1 trillion market capitalization earlier this year. It took them their entire existence to get there. And they became a $2 trillion company within 60 days. So the growth is just incredible. In fact, Apple is bigger than the entire Russell 2000 combined. So you have one company is bigger than 2,000 small cap companies in the US. And we have seen things similar, but we've never seen it to this extreme level. You'll notice that technology at 47, consumer discretionary, this was recalibrated. This is now effectively Amazon because that is the biggest consumer discretionary company out there, outpacing all of its rivals, except for maybe the great Amazon versus Walmart online shopping battle is upcoming. We will see how that comes out, but it is that is where the future of retail is as we look at it right now. Looking for largest or best performers here, the top 10 weighted stocks. Here they are. Facebook was the one I couldn't remember. Apple up 108% over the last year. Microsoft 53%, Amazon at 81%, Facebook at 47%, and Alphabet, the Class A at 20%. So you think about this, you have a company whose market or the cap weighting is 6%, Apple. It's 108% trailing 12-month return. That's going to move the market pretty significantly. We go down to Russell 2000. Again, these are small companies. I mean, and these should be much less familiar names, but hopefully some of them do make sense or do ring a bell. Penn National Gaming, up 290% over the last year. Sunrun, Caesars, Myocardia, Novax. And you look at the top 10 performing stocks for the quarter, Whiting Petroleum. This company declared bankruptcy earlier this year. So not something that you're going to have a lot of money in. And if you look at the bottom 10 performers here, a lot of energy and a lot of healthcare here. Again, these are the companies that were working on the vaccine and may have had a negative result, but then energy is just despised by the investing world right now. You can see here, international, not going to spend much time on this. Latin America, bad. Emerging markets, Asia, good over the last year. And again, this shows you the impact of currency, which dollar is a little bit weaker right now. And bonds. U.S. high yield bonds were the best performer during the quarter, up 4.6%. You look over the trailing year, some of the best places to be were Aggregate was up 7%, but again, you're looking at long-term treasuries are the best place to be. Very long-term treasuries. This is all treasuries right here, but long-term treasuries was the risk trade, and they did very well. Yield curve is here. So as of today, a 1-month treasury note or treasury issue 1 month from maturity is almost zero. You can see at the end of the quarter, 9/30, before yields ramped, the 30-year treasury at 1.5%. And again, this is not expected to change significantly over the immediate future. You can see we ended 2019, started this year, yield curve much higher, but the COVID recession, just yields went down rapidly, and there's almost no market to even sell bonds for a short period of time at the end of March. So going into the total fund, the total portfolio had a rate of return of 7.6% over the trailing 12 months, which I hope is a pleasant surprise for everyone. 7.6% during the fastest bear market, in a period that contains the fastest bear market in history, is much better than you could possibly or reasonably expect. And that's because the recovery has been so rapid and so strong. Looking at the total fund here it is, right? Here is the December to March period. And here are the 2 subsequent quarters. So we almost closed the gap in 1 quarter, but we were above where we were. And if you think about it, the timing of the crash was late February to late March. The market bottomed on March 23rd. And then since then, there have been some bumps in the road. October was a bump. We won't cover that, but you can see that the returns have been very, very positive. Allocation, a little hiccup here where fixed income increased during the quarter because of market changes, but we are back pretty close to this baseline that we trace across. Where are the assets invested? Domestic equity. Well, let's go to the total fund. So during the quarter, we started at 67.7 million. We ended at 71. So that's a nice increase in market value. The assets are allocated 60% to domestic equity, diversified allocation, core fixed income at 17.7, active duration bonds at 10.8. Remember, this is a hedging portfolio that does pay interest over time. International equity at 8 and high yield fixed income at 2.8. Remember how high yield performed pretty well during the quarter. Cash is held at a minimal level within this portfolio. This is not where you pay claims out of. So there's minimum cash in here. You can see the allocation by managers, dominated by the Vanguard S&P 500. You can see we have an active small cap. This is our active duration portfolio, our 2 bond allocations, international equity, another index fund by Vanguard, our mid cap value portfolio, which has performed how other mid caps have, Lord Abbett high yield, and then cash. One thing I want to sort of plant a seed is right now there is, I don't know if you're following this, but passive investing is much cheaper than active. Passive has been, sort of the domain of Vanguard for a long period of time. They've been, hung up their hat on being the least expensive index fund manager out there. But there's another company, Fidelity, which you see advertising on television a lot, have entered the space, and they are competing on price. The index funds that we have here are managed by Vanguard. However, Fidelity has undercut their price. There are some, I would say, some logistical issues that are under investigation right now. But if we can, trade out of this Vanguard 500 index and not be exposed to the market and instantaneously be holding the Fidelity fund, the cost is roughly half of what it is on the index fund, this is your cheapest fund already. So that's something to think about as we as we move into the end of the year and working with the bank to make that a riskless transition. Because if you think that you're out of the market one day, you can miss 30 basis points or, today 150 basis points, and you're trying to save 3.5 or 2.5 basis points. So again, the margin's narrow, but if we can do it without being out of the market, I think it makes a lot of sense. Looking at here, the income during the quarter. Now we're looking over the performance of the total fund here. The quarter, we're up 5%, 1 year at 7.6%. For the 3 years, up 7.22. These are annualized and net of fees. For the past 5 years, 8.94%. Again, actuarial assumption that we're showing here is 7.5. So we outperformed over the last 5 years. 7 years has been a bit difficult, 6.62 versus 7.5. Looking at the total fixed income allocation, again, this rolls up Loomis, Double Line, Lord Abbett, and Hoisington. For the quarter, 1.85% versus 0.62 for the benchmark. So that's a nice, attractive level of outperformance. We go out to the trailing 1 year, 6.76. Given that we had two managers that were heavily invested in credit earlier this year, we don't look as good as we would like to here. But as we go down this list, we had one negative return, slightly negative, Loomis Sales, invested a lot in corporate bonds. Double Line was positive at 4.26, but underperformed their benchmark. Lord Abbett was at 0.52. But then the MVP over the last year to date for the quarter is definitely Hoisington. They own treasury bonds. They own long treasury bonds. And so to see them outperform during a very high risk environment is not surprising. Again, don't expect this return going forward. Yields would have to go in the treasury market, would have to go below zero to do this. We don't expect that to happen. But again, if we need to source funds away from a portfolio, this is the way to do it. Looking forward, the highest yields amongst these is Lord Abbett, followed by Loomis Sales, and then Double Line. But again, 30% of the portfolio. This was a major move several years ago where we reduced our fixed income allocation because bonds just won't get us the return that we need. And given the length and the horizon of this portfolio, equities are the way to go. The two passive portfolios, again, most of the equities, a little bit more than half of it is invested in the Vanguard 500 index, and I'm completely comfortable with that. It's a low risk market exposure. You can see it tracks its benchmark very, very closely. The only question I have in my mind is Fidelity at 1.5 basis points versus 4, a better place to go. And we'll talk more about that in the coming months. Vanguard Midcap Index, definitely a nice performer here. You can see top quartile across the board. And Hotchkiss and Wiley showing how tough it has been to be a value manager and where they go even worse over the past quarters. I think that this fourth quarter of this year will be make or break for Hotchkiss. And I think that if we don't see some notable improvement during the fourth calendar quarter of this year, be prepared to either find a new one or roll it into this mid-cap index fund here. The whole idea of this portfolio is that stocks get too cheap in the marketplace, but somebody like Hotchkiss, who's, I will say, willing to buck that trend, can get nice returns out of that over time. However, the last 2 years have been the worst period for value investors that I've seen. Going to move on to the other portfolios here. Stevens is our small cap, their growth equity, and their return over the last year at 17.6 has been very strong. They've also outperformed over the last 3 and 5 years. And Causeway, which is a value equity manager, they're not as good as some of their peers over recent periods of time. A lot of that is due to them holding more of their portfolio in Europe than others. Japan and China have come back nicely. But this portfolio, long term, I think they have a better track record than we show right here. And I think I can show that in just a few pages. Unless there are any more questions about any of the individual portfolios, wait and see potential changes late this year on the index funds, potential changes early next year on Hotchkiss and Wiley to see how they perform during the quarter. Want to make sure that we're comfortable holding just 1/3 of the portfolio in bonds, which I'm very comfortable there. But again, the way we allocate that bond portfolio is important. And I think that this is a critical part of it. The Hoisington portfolio, 100% treasury bonds. Everything as of now is almost the nominal maturity of the bonds in the portfolio is 25. But if they see interest rates rising, they will go from 25 years to 90-day duration, which is extraordinarily helpful in an inflationary environment. You can see their return versus their peers. They're peerless, I would say. But again, when the bond market goes down, they can be a pretty painful place to be invested. I think that's all I'm going to talk about on the 930 report. It's a good report. We continue to do well. Not everything in the portfolio is performing how we would want it to. But like I've always said, if you don't have one part of your portfolio that's underperforming, you're not diversified. And really, diversification has not been the best place to be over the last 2 years, given the concentration in the U.S. equity market. But looking forward, I don't want to invest everything that we have in Apple. Or Amazon, I think, or Google. I think that there are some changes going on to that. It reminds me history doesn't repeat itself, but it does rhyme. It reminds me a lot of GE back in the late 1990s. You know, GE was the biggest and best and most admired company in the world. And today, I hate to say it's just a shadow of itself. You know, investing does it does move in cycles, and I think that we've been good to be in the index fund because that gets us good exposure to the overall market. But I don't think that it's going to continue to be the best performer forever. You can see we have Hotchkiss on alert and Causeway on alert because of performance. I concur. I suggest we leave them there. No other changes. And I like the fees here. You know, if we look at our expense ratio of the funds on a weighted average basis versus our averages for all of these, what we pay is 50 basis points. Category average is at 1.26, so we're saving 76 basis points. And on a fund the size of this, that's $280,000 of savings, I say, per year. And here is our benchmark index, very simple: 60% S&P, 10% EFA, which is international equities, and 30% bonds. We do not need to make any changes here, but like I said, if we are taking cash to pay benefits, we should take that from Hoisington. I don't think that we should allocate any more to Hoisington if there's cash coming in. Again, what this does for us is it forces us to sell high and buy low. And as investors, sometimes that's a tough decision, especially when we have periods of time where markets are dominated by one specific sector, like it is growth and technology right now. And here is very long-term returns here for all of the investments that we have. We go out 10 years, which is longer than we've had most of our investments here. 445 from Loomis versus 364 for its benchmark. Similar return for Double Line, a little bit better. You can see the Lord Abbett 653 versus 628. Hoisington, again, peerless returns here, 794 versus 364, doubled their benchmark, which is incredible. In bonds, you can see our indexes here, 1358 tracking, 1182 tracking there as well. Again, Hotchkiss has been really hurt by this recent period of time that's gone out to 10 years to handicap their returns. Stevens 1286, better than its benchmark. And Causeway, again, recent periods have this is the EFA. This is not the value side, which shown similar performance to US, but 337 annualized there. And I'm happy to take any questions here on that report.
All right, does anybody have any questions for Doug? With that, item 4 was just a presentation. Item 5 was to receive those flash reports for the 4 periods ending July 31st, August 31st, September 30th, and October 31st. I would like to entertain a motion on that one.
This is Garrison, also move, or I'll second.
Please record your votes.
This is Garrison, I vote yes.
And it passed unanimously. Thank you. Thank you, Doug, for all that you do for us and taking care of all of the funds that are there. So next item is discussion and consider approval of additional asset allocation. I believe we do not have any at this point in time. That's correct. So we'll go on to item 7, which is approved request for proposals for custody services. Matt Boggs, would you kind of just tell us briefly what that all pertains to?
Okay, this is for the custody bank for our just that holds on to our investments where our cash is, and that's the allocation where we go to purchase investments. And so Bank of Oklahoma has had this contract since May of 2016 that was approved for 1 year with 4 renewals. And so that is coming up, the finish of that contract in May of 2021. So this is anticipation of that. So in your packet is the RFP packet that will be advertised. Those will be open and we will be accepting bids up through December 30th. At that point, a committee will be formed in accordance to the city's purchasing and policing procedures to look at those bids that come in, to those proposals, and when someone is selected, we then move into the contract negotiation phase. We are anticipating in the May 2021 meeting to bring you the new contract for the custody bank services. And I'd be happy to answer any questions you might have about that.
Are there any questions? If not, I would appreciate a motion. Motion and a second. All in favor, record your vote.
Garrison votes yes.
And it passed unanimously. Thank you. The next item is items for individual, let's see. Items for individual considerations. Item 8A, a joint resolution authorizing agreement with Blue Cross and Blue Shield for a division of Healthcare Service Corp., a mutual legal reserve company, and concurrence with Oklahoma City Post-Employment Benefits Trust on behalf of the city of Oklahoma City. I believe we have Christian York on the call with us, along with Amy. I'm sure y'all can, but one of y'all feel free to explain what we're doing here, please.
Yeah, absolutely.
Christian.
Oh, thank you, ma'am. Can everyone hear me okay?
Yes.
Yes.
Perfect. So if the board is agreeable, what I'd like to do is cover down on all 3 contracts with a very short presentation. Also in prior year, we committed to bringing back some other general information about our plan offerings for the retirees. So I have just a very short snapshot on that with recent plan design changes, enrollment counts, things of that nature. I'm going to attempt to share my screen real quick and hopefully it works out for me. Oh, Francis, may I have access to share my screen, please, ma'am?
Yes, you should have access, Christian.
Here we go. Let's see here. All right. Okay, hopefully everyone is looking at the presentation there.
Yes, sir, we are.
Ah,
Yep.
perfect. Okay, perfect. Well, I appreciate the opportunity to talk to you about it. Let me just jump right into it here. So 3 separate items for your consideration this morning. Blue Cross Blue Shield is the first one. It is, as Brett indicated, for our dental contract for both our actives and retirees. This is a new contract with the existing vendor. So this will be a 5-year contract beginning on 1/1/21. And that vendor has been in place for, a decade plus at this point. We conducted an RFP earlier this year and had several proposals in there. But as we were evaluating that with the committee, none of the proposals could really duplicate the network offering of the current vendor, Blue Cross Blue Shield. In fact, I believe the closest competitor had about a 10% disruption in terms of providers, or in other words, 10% of our employees / retirees would actually have to switch their dentist or be out of network. And so Blue Cross Blue Shield really shined with the strength of their provider network. As far as impact to the trust, on the expense books, we're looking at approximately $934,000 to hit the expenses. But as you'll recall, the dental benefit is not subsidized. So that will be 100% offset by premium revenue from the retirees. So the net effect to the trust will be $0. I'm pleased to say that as part of the new contract, we did not receive a renewal increase. So the premium rates will be the same from prior year to this year. And we were also able to negotiate a rate guarantee for the life of the contract. It's a stepped increase, but it's in relation to year one. So over the life of the contract, we cannot see significant bumps. I believe 6% being on the high side, and that is relative to year one. So very pleased with the outcome of that contract negotiation. The second item for your consideration this morning will be the United Healthcare contract. And of course, they provide an HMO plan to our actives and our early retirees, as well as the Medicare Advantage plan that we added to our Medicare eligible members. In 2021 calendar year, that'll be the 4th year of that contract. So we'll be bringing back an RFP sometime in 2022. Estimated cost for the year is approximately $6.6 million to the expense accounts, with 50% of that covered by the retiree. We are still in that 50% split on our subsidy. So net impact to the trust, we're looking at right at $3.3 million for the year. The renewal rate that we negotiated for this year was pretty favorable at 3.8% on the HMO side. We had a 1.6% on the MAPD plan. And so moving pretty well, especially relative to the national trend. We're exceeding that benchmark significantly. A couple of plan design changes I'd highlight from that contract. We've added virtual visits to both the HMO and the MAPD plan. And really, that's part of a larger strategy. We've added virtual visits to all of our plans, including our clinic, which we'll talk about in just a moment here. And then one other significant change to the MAPD plan is we were able to negotiate removal of the 5% catastrophic logic that was impacting a number of our MAPD plan members. That gets very much into the weeds, but the gist of it is after the member pays some odd $6,500 out of pocket, they would switch rather than a copay, they would switch to a percentage of their prescriptions. And what that would do was on very expensive drugs, it would hit them in the last month or two of the plan year. And all of a sudden, a drug that they may have been paying $30 as a copay for would increase to several $100s. And we were able to get that in without an increase to our renewal rate. And so I think that's going to help a lot of our members. And it's also going to assist folks who are otherwise on the Blue Cross Blue Shield plan simply for that particular coverage, that they'll now be able to look at MAPD as an option. And then finally, we have the Blue Cross Blue Shield medical. Yes, I'm sorry, what's your question? Yes, ma'am.
I have a question about the increase. You said the impact to the trust on United Healthcare was 3.3 million. Is that an increase of 3.3 million?
No, it's not, ma'am. The total increase would only be that 3.8% or 1.6% on the renewal rates. So 3.3 is the total contract amount to hit the expense accounts there.
Got it. Got it. That's what I thought. And then that was contemplated in the budget amount that would be transferred from the city, right?
The renewal increases?
Yeah.
Yes.
Okay. Thank you.
Mm-hmm. All right. And so the final contract for consideration today is the Blue Cross Blue Shield medical renewal. It's the third of 4 optional extensions. So we'll be bringing back an RFP in early of 2022. Cost to the trust is estimated at $16.3 million, with half of that once again offset by retiree premium. So we're looking at a net of $8.1 million cost to the trust. Renewals for the year had a decrease of 12.5% for actives, an increase of 12.7% for early retirees, and an increase of 7.6% for our medical eligible, which, unfortunately, our early 65s have really been, or under 65s, excuse me, have been really riding the rate roller coaster. But we'll talk to that in just a little bit and put it in reference to a prior year. Unfortunately, it's just a very small group. So as people age into that group, if they have high cost claims, it dramatically impacts the rates. And then as they age into one of our Medicare plans, then they go the opposite way. And so unfortunately, it's just not something we can do to level it off for them. And then at this time, I'll just, they're not up for renewal, not up for consideration today, but I'll just mention that the two other benefits that we offer our retirees would be our vision and our basic life. And both of those have 0% renewals for the year. So premiums will be the same from year to year. And with that, this is my longest slide. So I'll take a breath and solicit any questions you might have about the contract piece of it.
Do you have any questions? All right, go ahead, Christian.
Perfect. Okay, moving on. What we're looking at here is enrollment for our medical plans for early retirees. And we have year-over-year enrollment for the month of June. We're still processing our open enrollment for 21. So we're actually stopping here at June of 20. But we expect that post-open enrollment, the trend will be likely the same. So referencing that HMO in the furthest left column, they comprise about 25% of our early retirees. Blue Cross Blue Shield alternate plan, that's our lower deductible plan, comprises about 12%. Oh, that doesn't look right to me, actually. I'm sorry. Let me jump back here. The Blue Cross Blue Shield plan comprises about 63%, excuse me, and then the standard plan at 12% of our membership. And you'll note that there is a downward trend on each of the charts. I don't believe that this is relative to migration or anything like that. The under 65 group is very subject to good retirement years, as well as birthdays, aging into that post 65 group, right? So I don't think we're seeing anything regarding trend or plan design issues here. We're just seeing an overall decrease in this population. Moving on, we'll look at the same slide for our Medicare retirees. And this one I assess a little bit differently. So the Medicare Advantage plan makes up about 41% of our plan. Blue Cross Blue Shield alternate is at 8%. And then Blue Cross Blue Shield standard is at 51% and declining. And here I assess a little bit differently. As I indicated, I think we are seeing migration. And so what's happening is people are moving off of the Blue Cross Blue Shield standard plan in favor of either the MAPD or the alternate plan. And I think that's indicating to us that there is a shift in priorities from, I'm using air quotes here, but the good plan, the plan that people are used to with Blue Cross Blue Shield, to very good plans, but something they're less familiar with for a lower cost option. And so I think it's telling us that price sensitivity is increasing amongst our retirees, and it's something we need to be aware of as we move forward, that we're providing them a good mix of plans that's not going to price them out of the market. I think right now we have a good place for them to fall to with that MAPD, but it's not universal because the MAPD does have some restrictions. Of course, you have to be Medicare eligible, but your whole family has to be Medicare eligible. So it's a good option for those who qualify, but it is something we're going to have to keep tabs on to make sure that we've got a good mix of plans for them. And I'm going to jump forward. Now we have a snapshot here of rates from 2021. Now these are the 2021 rates, even though we were looking at enrollment for 2020. And as a reminder, the retiree premium is 50/50. So we're looking at this from the retiree's perspective. This is what their monthly cost would be, but the city's perspective is exactly the same. Our cost is the same amount that you're seeing here on the screen. So relative to the private market, I'd assess that we're somewhat expensive relative to what we're seeing out there from our competitors and other employers. But I think that's to be expected because we have very generous plans. And it's still a tremendous benefit to the retirees simply because we're one of the few remaining employers that are offering these types of benefits. Now, what I'd like to do though for you is put this in context. So I'm going to show you the exact same slide, but I'm going to add the 2018 rates to it that the city and retiree paid. Now, I will give you one small asterisk, although I don't know that it's significant. Back in 2018, it was a 48-52 split. So the city was picking at 52%. So you'll see that reflected here, but I don't know that that is a huge component to the trend that we're looking at. So just as an exercise, looking at the relative rates, you can see that in that early retiree, the HMO, it's our most expensive option. It continues to be our most expensive option. Well, I say most expensive. It is one of our most expensive plans, and it continues to grow at that 4 up to 7% rate renewal every year. but it's such a small piece of our population that elect that HMO that it is what it is. But looking at the PPO alternate plan and the PPO standard plan, pretty interesting here. We're actually lower than we were back in 2018 in terms of premium costs to the retiree. And once again, what we're seeing here, I'd like to take complete credit for that, but I can't. It's really the roller coaster that we're seeing on renewal rates simply because it's such a small group. So retirees can expect to pay a little bit less than they did back in 2018, but I'm just going to hedge my bet and tell you that it will probably, swing the other way next year and so on and so forth. It's just one of those things that we have limited ability to control. Now, I think the story on stability, though, is in our Medicare eligible retirees. So as we look down at that second chart, the Medicare Advantage plan is slightly cheaper than it was back in 2018, which is huge. That plan has been very stable for us at less than 4% renewals every year. In fact, usually they've been closer to 2%. And then we've just seen that slight increase on our alternate and our standard plans. As you can see, it's about $20 more expensive on the retiree and the city for the monthly premium on the standard plan, and about $30 more expensive, on the alternate plan, and then about $30 more expensive on our standard plan. So really good. We'd love to see the number going the other way, but that's just not reality, right? So I think this is the best we can offer in terms of keeping that stability for the retiree in the city and offering a sustainable rate moving forward. So any presentation from HR would not be complete without a quick plug for the clinic. But I do have some good news about them and just a good status update. So as you're aware, we switched vendors back on 1/1/20. And truth be told, the transition was a little rough. We expected it to be. Short of standing up 2 clinics at the same time, there's just no way we could deal with that backlog of people who had appointments in the down months while we were transitioning equipment, training, and so on and so forth. But I'm pleased to report that we have caught up 100% with our backlog. That was achieved early this summer. And now we're actually to the point where we are only a few days out on our appointments. So you can get a few business days out appointment at any time. And they even have some same day availability. They're offering all the same services as prior. But what really has changed is our staffing. So through the negotiation process with the new vendor, our old staffing looked like 2 MAs, medical assistants, plus the physician. Sometimes they would plus up the medical assistant to 3. And that's where we were at. Under the new contract, we are at 2 medical assistants, the physician, an RN clinic manager on site, plus a PA. And so we have almost doubled our capacity with the new contract. And I'm pleased to report for the same dollars, or approximately the same dollars as the prior contract. We were right at about that $1.4 million mark. This year, we would expect it to be a little bit higher because we needed to purchase equipment and things like that for the new vendor and get them established. But over the life of the contract, we're actually expecting to save money. In addition to that, I highlighted it earlier, we did add virtual visits to the new vendor. And so you're actually able to see our on-site clinic at any time from the comfort of your home. And one of the biggest changes, especially for our retirees who love this, is when you call the clinic, you actually call the clinic, not a call center. So very happy with that change. I've heard a number of folks report back on that. And that's it. So with that, I'll just thank you for your time and then answer any questions you might have.
All
I
right.
should just say thank you to you and your staff.
Absolutely. Thank you.
Thank you, Christian. Anybody else have any questions? All right, so we need to vote on these, I believe, individually, as it says there in the agenda. So I need a motion and a second for item 8A. Got a motion, have a second. Please record your vote.
Garrison votes yes.
And the motion passes. Now for item 8B. Record your vote.
Garrison votes yes.
Thank you, sir. Passes unanimously. Now for item 8C.
Garrison will move to adopt.
A motion is second. Record your votes.
Garrison votes yes.
Thank you, sir. And the motion passes. Now we have item 9, which is receive the actuarial evaluation report for fiscal year ending June 30, 2020. And Matt, I believe we have somebody on the phone here today.
Yes, we do have a couple of representatives from Nyhart here, so I'm not sure who's going to be doing the presenting, but I believe they are on the call.
Yes, we are on the call. This is Cody Coker. I'm one of the people from Nyhart that Matt mentioned. Surge Data is also on the call. We were the main team that worked on this year's actuarial evaluation report. Do we know? Can I? Yeah, I think I can share my screen so I can pull up the reports so you can all see it. And I think it's part of your packet as well. So first off, we wanted to thank you for continuing to work with us and let us help with this report, and for having us today to kind of talk through it with you and kind of hit some of the highlights and the main takeaways from the report. So I guess going into the report, kind of the executive summary has the high level impact on what changed, liability from year to year. The city's liability has increased slightly, just a little bit year over year. The main driver of that is the discount rates, which I think sort of ties back to what we were seeing in the investment report as well, that interest rates are a lot lower, and the discount rate that we use when we put together this report is a blended discount rate between the trust's expected return on assets and a market-driven kind of municipal bond rate. So with those municipal bond rates being lower, that kind of drug down the city's discount rate, which pushes up the liability. So that's really kind of the main driver of where that liability increase is coming from. So that's something that we just have to update every year as we get, to a new June 30th date and see where that goes. So there's not really a lot that, we can do about that, or the city can, but that's sort of the main driver for that. There are also, of course, other things that impact the liability during the year in terms of demographic changes and health plan costs coming in higher or lower than we would expect. So that sort of all goes into that. So there's this executive summary at the front that sort of has the high level numbers. All of the sections after that really go through the specifics that, the city needs when it's putting together its financial statements of, disclosures that need to be included in there that sort of show how the liability and the assets change during the year, what the, expenses were, and keep track of things that, need to be reported. So that's really what a bulk of, I would say, the first half of the report is, all of those required disclosures that the city needs for its financial statements, information on what the asset allocation is and what those balances are. A discussion of the sort of actuarial determined contribution, which would be sort of our estimate of what a contribution amount would need to be to, fully fund the liability. That hasn't necessarily happened in the past, and it doesn't really need to necessarily. It's just sort of our recommendation of how things would look. So that's really something that's just, in there for your information of what those amounts would look like. The actual contributions have been different, but that's fine. The The trust is still working on investing and growing the trust over time and working towards that. So there is progress being made towards that, which is encouraging to see. And we like to see places that are building up their trust and working towards that point in the future of being, more closely funded to that full max. So that's, a good thing that we see there. And then kind of what I call the second half of the report, where we really go into a lot more detail about sort of the inputs and the information that goes into the report. So we have a page here that talks about the discount rate and how we developed that. So it's, like I mentioned, a blend of the long-term rate of return and kind of a market-driven bond rate that kind of gets blended together. The next pages have a summary of, the plan participants, how many active employees are there, what plans are they on, how many retirees are there, what plans are they on, what does that look like?
So Cody,
And
it looks like we went from a 13.1 to 13.8%. It's kind of the bottom line of funded. So we did show some progress.
yes, there's definitely some progress there, and that's what we like to see, is that funded percentage at that bottom line.
Sorry,
kind of going down.
go ahead. I apologize.
Oh no, that was a good question. Is there anything else that anyone had at that point?
Do any of the trustees have any questions for Cody? Take that as no. Cody, appreciate it. Anything else you'd like to just add?
No, I think that we've covered it. This plan provisions and the assumption sections are kind of very technical. That we probably go into a lot of detail there. I would just point to, there is this detailed actuaries notes page in the appendix. That's a really good reference on what assumptions actually got changed this year and what the impact was. So this is where we talk about the discount rate, a few small other things, and there was an update to COPPA subsidies that's reflected in COPPA liabilities. So I think that.
Okay.
Sorry, go ahead.
I need to just ask of Laura and Ted and Nell and Matt. When we go and review our assumptions on the ERS system, do we typically come back and review our assumptions on the OPEB at the same time? Has that historically happened that way, or is this just coincidence?
I don't know.
Okay, I was just wondering. So, okay.
Yeah, I think.
Nor do I.
I am concerned about the discount rate declining. I don't know. Given our investment returns, I'm just not sure that I understand that very well. So I would say that at some point there needs to be, by the finance department, an evaluation of that going forward. I'm not saying that I won't accept this report, but.
Right. Okay. All right. Well, we'll definitely do that. All right.
So I think that.
Go ahead, Cody.
Yeah, I was just going to say that if there were no other questions, that we wanted to thank you for having us and taking the time to, hear us out and have our presentation today. But like, if there are any other questions, feel free to let us know and we can answer those.
All right. Thank you, Cody. The staff, does the trust have any questions? Do you have any questions? Take that as a no. Okay, then with that, I would like to see about getting a motion to receive the actuarial report. Moved and seconded. Please record your vote.
Garrison votes yes.
Thank you, sir. And it passed unanimously. Item number 10 is to receive the schedule of regular meetings for the 2021 year. I think it stays pretty much the same, right, Matt? We use the same formats first of each quarter.
That is correct.
So with that, I would like to entertain a motion. Record your votes.
Garrison votes yes.
Thank you, sir. It's like, there it is. It's passed unanimously. Item number 11 is to ratify the claims listing that have occurred basically for the last 3 months. I would entertain a motion. Record your vote.
Garrison votes yes.
And it passed unanimously. We have item 12, which is reports, comments from trustees. Do we have any comments from the trustees? Seeing none, do we have any comments from staff or interested parties? All right, seeing none, here at 11:02, we are adjourned. Thank you.
Thank you.
Thank you all. Y'all take care.
Thank you.
Thank you.